All right, here's continuing the or the practice exam questions. And I don't think I said at the start. Highly recommend. I know I said in other places. Try these on your own first. Then come and look at the solution and see what you have and what you don't have. It's far better than listening to me walk through the solution or just reading the solution. Try the questions on your own. I really believe it's the best way to study. Question 22 is a warranty question. Okay, not uncommon to see warranties on an exam. So what happened here? Sell a dishwasher includes a 2-year warranty. Warranties for similar dishwashers can be purchased separately for $120. So again, somewhere in there it has to tell you what the warranty is worth or what the dishwasher is worth so that you can separate how much is dishwasher and how much is warranty. So there's your fair value for the warranty. During its first month of sales, 10 dishwashers were sold for $780. Calculated sale price should be allocated to each component using the residual value method. That's the only method we have. Record the required summary journal entries for the first month's sales. For simplicity, assume all were cash sales and occurred on the first day. The only thing that's, cash sales is you can debit cash and not AR. And then the first day of the month, what's relevant there is that we're going to want to record some warranty for this first month. If the assumption was all the sales happened on the last day of the month, then we wouldn't record any warranty for this month. So again, not a big deal, but watch the wording because it will affect your entry. So how much? Well, we sold them for $780. It told us the warranty value is $120, so the dishwasher must be worth $660. What happened? I got cash. I'm going to record sales revenue for the dishwashers because I sold them. It's a good, title transferred. And then the warranty's unearned revenue, right? Unearned warranty revenue. Any of that is fine. And then I want to record 1 month of warranty. So I'm going to get rid of my unearned revenue and record some warranty revenue for 1/24 of the balance. Again, I'm not real hung up on terminology. Unearned revenue, unearned warranty revenue, unearned warranty would be fine. Warranty liability would not because it's not a liability. Okay? And really that's all you can get with a warranty question. For an assurance-based warranty, if it was a service warranty, this is a service warranty. If it was an assurance-based warranty, and as I look at this, we don't really have a good indication. It should have told us that. I guess the fact that it told us that the warranty value is $120 points us to record this unearned revenue. 23 is a bad debt and allowance entry, so this kind of walks through the sales process. Not a lot different than the assignment, Wiley Plus assignment entry, and some practice questions that were along the way. So we've got balances and instructions. Donald records a monthly allowance for doubtful account equal to 1% of sales, which has not been recorded for December. Prepare the entry. So December sales, 300,000, 1% is 3,000, so that's my debit bad debt expense credit allowance. The other thing you might see sometimes on a question like that is you only would take an allowance on credit sales. So it might have said we had $300,000 of sales, 90% were on account and 10% were cash. We'd only want to take a bad debt expense on the credit sales, not on everything. Review of accounts receivable at December 31 indicates that 8,000 need to be written off. Prepare the entry. So with creating an allowance, the whole thing there is you're not recording an expense when you write something off. When you write something off, that's confirmation of what you estimated earlier, so you're going to debit the allowance and credit the accounts receivable to take it out of your accounts receivable listing. C, the review also indicates that the remaining balance of the allowance account at December 31 should be $42,000 credit. Very standard entry. At the end of the month or the end of the year, we need to adjust the allowance to what it should be. Right? The $3,000 entry we did is just to try and keep up, but at some point in time we need to analyze, is the balance okay? So in this case, we want it to be $42,000. Based on everything we've recorded so far, it was $50,000, right, in the accounts they gave us at the start. We recorded a $3,000 entry to it, credit allowance for $3,000, and then we took $8,000 out for the write-off. So it's sitting at $45,000. In order to get it to $42,000, we need to debit it for $3,000. Right? So $45,000 credit, I need to adjust the balance to a $42,000 credit, so I need to debit it by 3. Use T accounts here if it helps. I find they are very helpful. And prepare the balance sheet disclosure, including account name and amounts based on the entries from Part A to C above. So your balance sheet should have accounts receivable, which we've adjusted here, and allowance for doubtful accounts. Or you can do it on one line and just say net of the allowance. Disclosure required is you need the amount of the allowance, whether you have a separate line or whether you include it in the verbiage. Either of these approaches work. 24 is a sale of accounts receivable. Very, very standard stuff. We sold $425 of accounts receivable, so that's credit AR. I'm just going through and reading. Everest Finance assess a finance charge of 5% of the total accounts receivable. That we record as a loss on sale of AR. I'm also fine if you call that finance expense. It's as long as it hits your income statement. But the textbook uses loss on sale of AR. And they retain an amount equal to 2% of the total receivables to cover sales discounts. So the 2% is different. That's just saying they're not going to pay you that 2% today because they want to make sure your customers actually owe you that. If the customers take discounts, or sometimes they'll do refunds or returns, then the factor, the company giving you the money, will withhold some money. So they will pay you that amount. They just have to wait and confirm it's the right amount. So that becomes an accounts receivable from the factor for 2% or $8,500, and the balance is cash. Again, remember, the whole factoring transaction is someone's giving you money for your receivables today, and then they'll collect your receivables for you. And 25, do not pay for 1 year promotion. Sold these things for $4,200, due and payable in a year. Provide similar consumer loans with an interest rate of 18%. Okay, so as soon as you see that do not pay for a year or no interest, non-interest bearing, anything that's a year or more has to be present valued. So in this case, again, use your calculator or the simple present value. It's $4,200 divided by 1 plus the interest rate, so 1.18. So the sale of the refrigerator is actually just for $3,559. So I'm going to have a note receivable for $3,559 and sales revenue for $3,559. I don't have a cost of goods sold entry here because they didn't tell me what the balance was, but if they did, I'd throw that in too. And then December 31, and again, watch the periods. This happened March 1st, so at year end, 10 months have gone by. I'm going to record my interest on the note. And next February, I'm going to get cash because they're going to pay for their non-interest. Okay, and I think that is it for the practice exam. Again, practice, practice, practice. Keep trying questions. There's lots of them out there. And I would also have this available when you do the exam, right? It's an open book exam. You're at home. Generally, there's only so many things that can be on the exam. Most of the key topics will be. And, if you have similar questions there, it might help you with some of the account names and debits or credits. Thanks. Send me your questions. Good luck.